Welcome back to the deep dive. I have a stack of documents on my desk today that honestly reads less like a financial report and more like, I don't know, the screenplay for a really dark, really expensive satire. We've got court filings from the British Virgin Islands, leaked WhatsApp messages, liquidation reports.
And interviews conducted from undisclosed locations.
Exactly.
It is quite the stack. Usually when we look at financial collapses, we're dealing with, pretty dry, boring things, interest rate mismatches, regulatory gray areas, dull accounting errors. But today we are looking at something entirely different.
We are looking at Three Arrows Capital, or 3AC. And just to set the stakes here for you, we are not talking about some small hedge fund having a bad quarter.
No. Not at all. We were talking about the firm that was, for a brief moment, kind of like the central bank of the crypto universe.
Right.
When they collapsed in 2022, they didn't just lose their own money.
No.
They vaporized roughly $3.5 billion of other people's money. They left a blast radius that took down lenders, exchanges, and thousands of retail investors.
And that is the what? But the how and the who are what we are digging into today, because the main characters here, Su Zhu and Kyle Davies, they aren't your typical, Bernie Madoff villains who hide in the shadows. They're distinct.
That's a diplomatic way to put it.
We are talking about guys who ghosted their creditors to go surf in Bali. We're talking about a $150 million yacht named Much Wow.
And you can't forget the permaculture farm in Singapore.
Oh, right. Filled with specific breeds of dragonflies. It's just absurd. But our mission today isn't just to gawk at the absurdity. It's to figure out how two high school friends convinced the smartest lenders in the world to give them billions of dollars with. And I was shocked when I read this. Almost no collateral. How does that even happen?
Well, it happens because of a very specific type of modern delusion. It's a story about what happens when you mistake leverage for genius. And to understand the collapse, you really have to understand the psychology that built the machine in the first place.
So let's rewind. Before the yacht, before the billions, before the prison sentences, who are these guys? Because in the photos I've seen, they look like pretty standard finance bros.
And that's where it starts, surprisingly, in a very traditional way. Su Zhu and Kyle Davies met at Phillips Academy in Andover.
Okay, so Phillips Academy, that is the elite of the elite. That's old money, prestige, the whole 9 yards.
Exactly. It's a feeder school for the Ivy League.
Yeah.
And that's exactly where they went. They both landed at Columbia University. They followed the golden path of finance, good school, math degrees, and then straight onto the trading floor at Credit Suisse.
This is important context, I think. They weren't crypto-native hackers living in a basement mining Bitcoin on a laptop.
No, not at all.
They were institutional. They spoke the language of Wall Street.
They did. And that pedigree is, I think, partially what allowed them to get away with so much later on. But they didn't stay in Credit Suisse for very long. They had an itch. In 2012, they quit the bank and launched Three Arrows Capital.
2012. Wow. Bitcoin is barely a blip on the radar then. Were they buying crypto back then?
No. And this is the part of the story most people miss. For the first 5 or 6 years, Three Arrows Capital wasn't a crypto fund at all.
Really?
It was an FX arbitrage fund.
Okay, let's pause there. FX arbitrage. We hear this term arbitrage a lot. Break that down for us. What were they actually doing day to day?
So in the simplest terms, arbitrage is, finding the same item sold for 2 different prices in 2 different places, and you pocket the difference. Sue and Kyle focused on emerging market foreign exchange derivatives, specifically NDFs, non-deliverable forwards.
That sounds incredibly dry. Why those currencies specifically? Why not just trade the euro or the US dollar?
Because the major markets are just too efficient. Everyone knows the price of the euro down to the microsecond. But in emerging markets, think the Indonesian rupiah, the Korean won, the Indian rupee, the pricing can get messy. Electronic trading platforms would sometimes show a price that was lightly stale or slightly different from the real market price.
So they were hunting for glitches, like mistakes in the matrix.
Essentially, yes. They wrote code to scrape these electronic platforms. If a bank's computer said the price was X, but the real market was Y, 3AC would just smash the buy button, lock in the profit, and then sell it instantly.
That sounds risky. Or is it free money?
In theory, it is free money. It's supposed to be risk-free profit. But here's the catch, and this tells you everything you need to know about Sue and Kyle's psychology. To make real money on these tiny price differences, you have to trade massive volume. We're talking about picking up fractions of a penny millions and millions of times.
The steamroller strategy.
Exactly. Picking up pennies in front of steamroller. But the steamroller here wasn't the market crashing. It was the banks themselves. See, the banks hated this.
Why? I mean, if the bank posted the price, surely they have to honor it.
You would think so.
Mm-hmm.
But in the fine print of these electronic trading agreements, banks often have a last look clause. It basically says, oops, that price was a mistake, we're canceling the trade.
So the bank can just call a do-over. Just say, just get it.
Yes. And most traders, when a bank cancels a trade, they say, okay, sorry about that, let's maintain the relationship, we want to keep trading with you tomorrow. Sue and Kyle, they did the absolute opposite.
What did they do?
They fought every single cancellation.
Really?
They would refuse to let the banks back out. They'd quote the rule book. They'd threaten legal action. They would basically hold the trade hostage and say, you posted the price, you have to pay us. They were incredibly aggressive.
So they're biting the hand that feeds them. That seems really short-sighted.
It was. They treated the banks as adversaries to be beaten, not as partners. And it worked. For a while, they made millions. But you can only poke the bear so many times. By 2017, the major banks, we were talking the big global players, had had enough. They started deplatforming 3AC.
They got kicked out of the casino.
They did. They had the capital, they had this hyper-aggressive mindset, but they had nowhere left to trade. The FX market was effectively closed to them. And this is a crucial pivot point. It's 2017. Where do you go if you have a high risk tolerance, a lot of cash, and you hate the traditional banking system?
And go to crypto.
You go to crypto. And this is where the story shifts gears. They took that same exact strategy, aggressive, leverage-heavy, finding inefficiencies, and applied it to a market that was the Wild West.
It's like taking a Formula One driver who's used to a pristine track and just dropping them into a demolition derby.
That's a perfect analogy.
So let's talk about the rise. Once they made that switch, they didn't just participate. They dominated.
They scaled incredibly fast. By March of 2022, the blockchain analytics firm Nansen estimated they managed about $10 billion in crypto assets, and 3AC's own last public statement claimed a net asset value, or NAV, of $18 billion.
$18 billion. That is a staggering number. But wait, if they started with millions from FX trading, how do you get to $18 billion in 5 years? Even with crypto going up as much as it did, that math seems aggressive.
That is the right question to ask. And the answer is borrowing. There's significant evidence, and certainly looking at the bankruptcy filings now, that most of those visible assets weren't really theirs in the traditional sense.
What do you mean?
They were sourced from uncollateralized borrowing.
Uncollateralized borrowing. Okay, let's unpack that. If I go to a bank for a mortgage, I have to pledge the house. If I don't pay, they take my house. What does uncollateralized mean in this context?
It means they were borrowing on a handshake and a reputation. They would go to a lender like, say, Voyager or Genesis and say, look at our assets, look at our track record, lend us $500 million in Bitcoin. And because 3AC was the golden child of the industry, the lenders just said yes.
Without asking for $500 million worth of insurance or some other asset to back it up.
Often with very, very little. Or they would accept collateral that was itself just other volatile crypto tokens. It was a house of cards built on trust and, frankly, FOMO from the lenders.
And Su Zhu made sure to maintain that image, right? He wasn't exactly keeping a low profile during all this.
Not at all. He became a massive influencer. He amassed over 500,000 Twitter followers. They weren't just traders. They became the thought leaders of this super cycle.
The super cycle. I remember this vividly. This was the thesis that crypto was done with the boom and bust cycles. From now on, it was just going to go up forever because of institutional adoption.
That was the thesis, up only. And because they were so loud about it, and because they had so much money under management, people believed them. They backed major projects. I mean, if you look at their portfolio, it was a who's who of the 2021 bull run.
Like what?
Aave, Avalanche, WorldCoin, BlockFi, Deribit, Ethereum, Polkadot, Solana, WO Network, you name it, they were in it.
It sounds like they just bought the entire market.
They practically did. But they had a few specific bets that were absolutely massive. And these are the ones that eventually came back to haunt them. And the biggest one, the one we really need to understand, is the Grayscale Bitcoin Trust, or GBTC.
Okay, GBTC. In the sources, this comes up over and over again. It was their primary engine of wealth, and then their coffin. But I'll be honest, the mechanism here is a little confusing. Why would you buy Grayscale Bitcoin instead of just buying Bitcoin?
This is the multi-billion-dollar question. Yeah. To understand this, you have to understand that back in 2020 and 2021, big institutional investors, pension funds, retirement accounts, they couldn't just go to Coinbase and buy Bitcoin.
Right.
Regulations didn't allow it.
Right.
Their charters wouldn't allow them to hold magic internet money directly.
Right. They need a regulated product, something that looks like a stock they can see in their brokerage account.
Exactly. And GBTC was the only game in town. It was a trust that held Bitcoin, and you could buy shares of the trust. But because it was the only way for big money to get exposure, those shares traded at a massive premium.
Give me a number. What kind of premium are we talking about?
At times, their shares were trading 40% higher than the value of the Bitcoin that was actually inside the trust.
Wait, let me get this straight. So if I have $100 worth of Bitcoin in the trust, people were paying $140 just to own the paper claim to it.
Yes, it sounds insane, but that was the market inefficiency. And Su and Kyle, you have to remember, are arbitrage traders at heart. They saw this and said, this is free money.
Walk me through the trade. How did they exploit this?
It's a loop, a beautiful, simple loop. Step 1, you borrow Bitcoin from a lender. Step 2, you give that Bitcoin to Grayscale. In exchange, Grayscale issues you shares of GBTC at the net asset value, basically the base price, the one-to-one price.
Okay. So I handed over $100 of Bitcoin. I got back a share that the market says is worth $140. I've just made $40 instantly.
On paper, yes. But there's a catch, a big one, the lockup period. Yeah. You can't sell those newly created shares for 6 months. You have to hold them.
Ah, okay. So you're betting that in 6 months, that premium will still be there or even be higher.
Correct. They were betting that the hunger for Bitcoin from institutions would stay so high that the shares would always be worth more than the coins. And for a long time, they were right. They did this loop over and over again. Borrow Bitcoin, convert to GBTC, wait 6 months, sell at a huge profit, pay back the loan, and keep the difference.
Yeah.
It was a money printer.
Until it wasn't.
Until it wasn't. Until Canada launched a Bitcoin ETF. Until other options appeared. Suddenly, institutional investors didn't need GBTC anymore. The demand dried up. And that premium, it didn't just vanish, it flipped.
It went negative.
Deeply negative. It went to a discount. Suddenly, that share backed by $100 of Bitcoin was trading for $80, $70 on the open market.
And 3AC is holding how much of this stuff?
As of the end of 2020, they held almost 39 million units. They were the largest single holder in the world. And remember, they borrowed the Bitcoin to create those shares. So now they owe the lender 1 Bitcoin. But the asset they hold, the GBTC share, is worth less than 1 Bitcoin.
They are completely underwater.
And because they used leverage, they didn't just lose their profit, they lost the principal. And unlike a normal stock, they couldn't just sell the underlying asset. You cannot redeem GBTC shares for actual Bitcoin. It's like the Hotel California. You can check in, but you can't check out.
So they were trapped, just trapped in a burning building with no exit door.
Exactly.
That is terrifying. But they didn't stop there, did they? Because I guess if you're losing money on one massive bet, the gambler's fallacy says you should double down on another one. Enter Luna and Grayscale.
Right. While the GBTC trade was slowly bleeding them out, they made a massive directional bet on Luna and Grayscale. In February of 2022, they invested approximately $200 million in Luna and Grayscale tokens.
$200 million. And this wasn't an arbitrage play, was it? This was just, I believe in this project.
This was pure ideology. Su Zhu was close with the founders of Terra Luna. He believed in the algorithmic stablecoin model. It was a statement play. He was signaling to the market, the supercycle is real and Luna and Grayscale is the future. He was all over Twitter pumping it.
And we all know how that ended.
We do. In May 2022, Luna and Grayscale collapsed. It went to zero. And it happened so fast that $200 million, it essentially evaporated in a matter of days.
So just to recap the situation, we have a fund that is trapped in an illiquid GBTC position that is trading at a huge discount. We have a $200 million hole from Luna and Grayscale. And on top of all that, the entire crypto market is crashing because of macroeconomics inflation, the Fed raising rates.
The dominoes were perfectly aligned. All it needed was a push. And that push was the broader market decline in June of 2022. Bitcoin dropped, Ethereum dropped, and this is when the margin calls start coming in.
Let's talk about that moment, the catalyst. Because a margin call is basically a lender calling you up and saying, hey, the stuff you gave us as collateral isn't worth enough anymore, send more cash or we sell your stuff.
Exactly. And usually, a fund will sell some liquid assets to cover it. But 3AC didn't have liquid assets. Their money was stuck in GBTC or locked in private equity deals for projects that hadn't even launched yet, or it was completely vaporized in Luna and Grayscale. They had no cash.
So what do? Do they call up their lenders and say, hey, guys, we're in a bit of a bind, let's work this out?
No. They went dark. This is the ghosting phase. Lenders were calling, emailing, sending messages on Telegram. Nothing. just radio silence.
I cannot imagine being a lender at Voyager Digital or Genesis realizing you lent hundreds of millions of dollars to these guys and they just won't pick up the phone.
It creates absolute panic. On June 16, 2022, the Financial Times broke the story that 3AC had failed to meet margin calls. That was the death knell. Once that news is out, every other lender rushes to liquidate whatever tiny bits of collateral they do have.
It's a run on the bank, but the bank is 3AC.
Precisely. On June 22, the Wall Street Journal reported they failed to repay loans to Voyager Digital. Then on June 27, Voyager issued a formal notice of default. 3AC failed to pay a loan worth more than $665 million.
Wow.
That was in Bitcoin and USDC.
$665 million just gone, defaulted on.
And that same day, June 27, the legal hammer came down. A court in the British Virgin Islands ordered the liquidation of Three Arrows Capital. They appointed a firm called Teneo to oversee the whole mess.
So the party is officially over.
It was. By July 2, 3AC had filed for Chapter 15 bankruptcy in the U.S. to protect its assets from being seized. And the filings? They revealed the true extent of the damage. They owed 27 different creditors a total of $3.5 billion.
Hey, $0.5 billion.
Right.
And the fund itself, what was the final tally of the loss?
The fund lost in excess of $3 billion over 2021 and 2022. It goes down as one of the largest hedge fund trading losses of all time, period.
It's just hard to even wrap your head around those numbers. But what makes this story so critical is that 3AC didn't die alone. They took people with them. This is the contagion we talked about in the intro.
That's the so what of this story.
Yeah.
Why does it matter if one hedge fund fails? It matters because 3AC was so interconnected, they were borrowing from everyone. So when they defaulted, those lenders suddenly had massive holes in their own balance sheets.
Voyager Digital being the prime example here.
Voyager was a direct casualty. The 3AC default was partially, if not mostly, responsible for Voyager's own bankruptcy. They had lent a huge chunk of their customers' money to 3AC. When 3AC couldn't pay, Voyager couldn't pay its customers.
I want to pause on that for a second. Why on earth would Voyager lend that much money, customer money, to one single counterparty? It just seems unbelievably reckless.
It was. But you have to remember the environment at the time. 3AC was considered the risk-free rate of crypto. They were seen as too big to fail. Voyager thought if we lend to Su and Kyle, we're safe. They were chasing yield. 3AC was paying very high interest rates to borrow that crypto. Voyager needed that yield to pay their own customers those high rates they were advertising. It was a yield trap.
And it wasn't just Voyager, was it?
No, not by a long shot. Genesis Trading, one of the biggest prime brokers in the entire space, was hit hard. Their CEO, Michael Morrow, announced substantial losses from loans to 3AC. Their parent company, DCG, actually had to step in and assume the liabilities just to keep Genesis from collapsing right then and there.
Even blockchain.com had to do layoffs because of the impact.
Correct. It rippled everywhere. Even Sam Bankman-Fried, and I know it is so ironic to quote him now given everything that happened later with FTX, but even he at the time blamed 3AC for causing the ripple effect that froze assets across the industry. He saw 3AC as the first big domino that destabilized the whole system.
It's wild to think about that timeline. 3AC falls, which weakens everyone else. It creates this massive credit crunch. And then a few months later, FTX itself collapses. It was just a brutal, brutal year.
It was a systematic unwinding of leverage. One piece fell and took all the others with it.
Now, here is where the story shifts from a financial tragedy to, I don't even know what to call it, a farce, a mystery. Because while their company is imploding, while creditors are screaming for their billions, Su Zhu and Kyle Davies decide to pull a vanishing act.
This is the ghosting phase we mentioned. Liquidators from Teneo reported that Davies and Zhu were simply not cooperating. They weren't answering questions, they weren't providing documents. As of July 8, 2022, their whereabouts were officially unknown.
Just gone, like Interpol notice gone.
Pretty close to it. They eventually surfaced for an interview with Bloomberg, but even that was conducted from an undisclosed location. In it, they mentioned they were planning to move to the UAE.
Which conveniently has no extradition treaty with Singapore or the U.S.
Precisely. They were running, and while they were running, details started coming out about the lifestyle they left behind. And this is where we absolutely have to talk about the yacht.
The yacht. Much wow.
That was the name. Much wow. A nod to the Doge meet.
Of course it was. Because nothing says serious institutional-grade financial firm like a Doge meme on a mega yacht.
It was a $150 million vessel. The sources say it was purchased, or at least commissioned, during the peak of their success. But as the liquidity crisis hit, it became the symbol of their excess. $150 million that could have gone to creditors sunk into a boat named after a meme.
It's almost too perfect a metaphor for the whole situation. But they weren't on the yacht when this all went down, were they?
No. While the liquidation was happening in June 2022, while their employees were wondering if they still had jobs, the New York Times reported that Su and Kyle were in Bali.
Bali, surfboards and smoothie bowls.
Su Zhu was reportedly trying surfing for the first time. Kyle Davies was dabbling in painting and meditating.
I have to quote Davies here because this line drove me crazy when I read it. He said, and I quote, "I really spent so much time meditating in Bali that I'm really just pretty zenned out."
It is a staggering lack of self-awareness. Or maybe it's the ultimate awareness.
What do you mean?
You've just destroyed billions of dollars of wealth, people have lost their life savings because of the contagion you caused, and you are zenned out painting in Bali. It's so far beyond normal human reaction.
It's the ultimate pivot. From master of the universe to Zen monk in 3 easy steps. It feels like a defense mechanism. If you pretend it doesn't matter, maybe the guilt doesn't crush you.
Or perhaps it reveals how they viewed the money all along, as numbers on a screen, a game. And if the game resets, you just go meditate until the next round starts.
And we can't forget the Singapore residents. Before they fled, Zhu and his family lived in what's called a good-class bungalow in Singapore.
Which is real estate speak for unbelievably, obscenely expensive mansion.
Yes. But it wasn't just a house, it had a permaculture farm.
A permaculture farm, an elaborate system of lakes and gardens designed to replicate self-sustaining ecosystems. It was home to ducks, chickens, and, as you mentioned, numerous types of dragonflies.
There is something deeply, deeply ironic about that. They were obsessed with building a self-sustaining ecosystem in their backyard, filled with dragonflies and ducks, while simultaneously destroying the financial ecosystem they were a part of.
It speaks to a certain type of mindset, I think. The desire to control complex systems. Whether it is an algorithmic trading strategy or a permaculture pond, they believe they could engineer a perfect loop. But in finance, unlike in a pond, you can't control the external variables. You can't control the Fed, you can't control panic, and you definitely can't control the price of LNA.
So they're in Bali, they're zenned out, the yacht is somewhere. Actually, I read the yacht was repossessed before it was even fully delivered, right?
That's correct. The shipbuilder eventually sold it to someone else.
Yeah.
Much wow, never really set sail under their command.
Another perfect metaphor. Okay, so the money is gone, but the law does have a long arm. Let's fast forward to the consequences. Did they get away with it?
Well, yes and no. It's complicated. In September of 2023, Su Zhu was actually arrested.
Finally, where?
At Changi Airport in Singapore. He was trying to leave the country.
Trying to fly out, probably back to the Zen life.
He was arrested pursuant to committal orders. Basically, he was sentenced to 4 months in prison.
4 months? For losing $3 billion, that's
Right.
incredibly light.
No, and this is a really important distinction. He wasn't sentenced for the financial loss itself. Being bad at trading isn't a crime, usually. Unless there is proven fraud, losing a lot of money is just losing a lot of money.
So what was the prison time for?
He was sentenced for failing to cooperate with the liquidators. It was a contempt of court issue.
Ah, okay. So it was for the ghosting, not for the losing.
Correct. And his review of prison was, well, it was surprising.
Do tell.
He later described his time in prison as really enjoyable.
You're kidding me? Enjoyable.
He said it was enjoyable because he didn't have internet or caffeine or alcohol. He treated it like a forced detox retreat. He said he read books and did push-ups.
Only Su Zhu could turn a prison sentence into a wellness anecdote. 5 stars, great for dopamine fasting, would recommend. It's unbelievable.
It fits the pattern, doesn't it?
Yeah.
Reframing every single failure as part of the grand journey. Meanwhile, Kyle Davies' location remained unknown during Zhu's arrest, though he was subject to the same committal order. He managed to stay out of the net.
So Zhu does his time, Davies is in the win. You would think after all this public shaming, after the bankruptcy, after the prison stint, they would just fade away. Maybe open a real surf shop in Bali.
You would think, but this is where the story gets into zombie territory. They didn't leave the industry. Despite the collapse, despite the reputation damage, they came back.
And they didn't just come back as traders, they started an exchange.
Yes. In late 2022, they launched OPNX, which stands for Open Exchange, based out of Hong Kong. And get this, it was a marketplace for trading bankruptcy claims.
That is unbelievably ironic. They create a market to trade the debt of companies like the ones they helped destroy.
It is the ultimate cynical pivot. We broke it, now let us help you trade the pieces. They were allowing people who lost money in FTX, Celsius, or Voyager to sell their claims for immediate liquidity.
It feels like an arsonist starting a fire extinguisher company the very next day.
Davies even tweeted about it. He said, and this is a direct quote, "I'm getting early 3AC vibes all over again. Nothing compares to the energy of a startup."
Early 3AC vibes. I don't think that's the flex he thinks it is. Hey, remember that time we started the thing that eventually imploded and ruined countless people? I'm getting that feeling again.
It shows a complete disconnect from the trauma they caused. Or maybe it shows that they know exactly what they're doing. They know that in crypto, controversy sells. And they didn't stop there. In early 2024, they joined as advisors for a platform called OX.UN.
OXFUN. The name alone.
Another exchange. This one, a gamified trading platform with the dual token model.
Gamified trading, just what the world needs more of, because the problem with crypto is that it wasn't enough like a video game.
And then, late 2024, the cherry on top.
A meme coin. Of course. It had to end with a meme coin.
The 3AC token,
Yeah.
a meme coin project they were directly connected to. It had a 1% transaction tax, high insider concentration, basically all the red flags of a quick cash grab.
And it faced criticism, I assume?
Massive criticism. It was volatile, illiquid, basically a microcosm of everything risky and predatory about crypto, packaged with their infamous brand on it.
It's baffling. If I lost $3 billion, I think I would change my name and move to a cabin in the woods. These guys launch a token named after their own failure.
It raises a fascinating question about the crypto industry itself. In traditional finance, if you blow up a bank, you are usually done. You are a pariah. In crypto, notoriety is a form of currency. The fact that they are famous even for failure gives them attention, which they can then monetize.
That is a deeply depressing thought. It rewards the spectacle, regardless of the outcome. Okay, let's bring this home. We've covered the origin, the rise, the crash, the yacht, the prison detox, and the zombie comeback. What is the big takeaway here?
The story of Three Arrows Capital is the definitive lesson in leverage and contagion in the modern crypto era. It showed us that the crypto ecosystem was not a decentralized mesh of independent actors. It was a tightly wound ball of yarn. When one thread Luna pulled, it unraveled 3AC. When 3AC unraveled, it took down the lenders like Voyager and Genesis.
It was a house of cards where everyone was borrowing from everyone else to buy the same assets.
Exactly. And the assets backing it all were volatile tokens that could vanish in value overnight. It was an $18 billion illusion built on the idea that the music would never, ever stop.
And when the music stopped, there were no chairs left.
And the people running the game just walked out the back door to meditate in Bali. Liquidators are still seeking to recover $1.3 billion from the founders. That money belongs to creditors. It belongs to the people who trusted the system.
And meanwhile, the founders are out there launching gamified exchanges and trying to get people to buy their meme coin.
Which leads to the provocative thought for you to think about today. If the architects of a $3 billion collapse can return to the industry within 2 years to launch meme coins and new exchanges, has the industry actually learned anything about due diligence?
Or are we all just waiting for the next much wow?
I fear it might be the latter. As long as there is greed, there will be people like Su and Kyle willing to sell the dream of infinite leverage.
On that uplifting note, thank you for listening to this deep dive into Three Arrows Capital. It's a wild story, but a necessary one to understand the world of crypto.
Always a pleasure. Keep questioning the numbers and always ask what the collateral is.
We'll see you next time.